Secondary session, episode 2, my friends. Today, back with Rob Pieklo from AFR. We're going to talk a lot about locks, about hedges, why it makes the mortgage space really go round and round. So, Rob, I just want to get right into it here. Why are locks just so important, and why do lenders have to get it right? And what does it mean when I say have to get them right? Some people don't know that lenders actually have to figure out a way to get these right all the time.
Yeah, well, thank you again for this. This has been fun so far. We're in this is session 2, and this is an area that is near and dear to my heart because nobody understands it, and it's one of those things that I see. I probably get the most questions around. Why is it a big deal if I just switch lenders? Like, why can't I just switch lenders, and why can't I just take the loan over there? Who cares? Like, I just want to get a better rate, and kind of want to talk through that, and a lot of questions about rates got better. I should get a better rate for my client, even with the lender I'm at, and kind of want to go through those items. And it starts off really simple. Is that a lock in our world in mortgage accounting? Mortgage accounting is stupid. We've talked about it. It's really dumb. The way it works, it's actually revenue is booked the minute you hit submit lock button. So when you hit that lock button to a lender, immediately that is transferred as revenue for that company, and you book it initially at whatever the pull-through rate is, whatever the percentage of those loans that usually close is how you actually book your revenue for a mortgage company. Actually, fundings in the accounting scheme of things is just a reconciliation of loans, of revenue. It's not actually a function that is an accounting event. It's basically your initially rate at lock is when it matters, and that kind of lock as it flows through and how it progresses is how your company is going to determine whether they're financially successful or not. So a lot of people don't know that part. Can you imagine, Starbucks, if there's a line in the drive-through, and can you imagine that that Starbucks would start booking revenue, not when you bought your coffee, but when you're in line for coffee and you haven't even paid for it yet. And that's kind of how it works on the mortgage world. So that's the importance, and is why we freak out over locks themselves as a lender. But that's the main driver why. So that part of it is odd. Like I said, it's different, and because it accounts for it there. When that loan goes away, the revenue goes away also, even though it didn't fund yet. But that's the main culprit of why locks are so important.
Yeah. So I want you to fill me in more because I'm writing down questions right now. So I assume this is why on companies that are publicly traded, they're basing it strictly off of locks as opposed to the actual funding of it. Is that just been something that's been around since this has started? And do you know where that actually originated from? Why would the focus be on the lock?
Yeah, it's fair accounting standards require you to book revenue when you know that there's a very good chance you're going to receive it.
Correct.
So that's the fair accounting standard, and I think FAS 32 is technically the rule, and it's just part of GAAP accounting of when you have an opportunity to say, yeah, revenue is going to come in at this level, at this scale. This models out that it comes in at this level all the time. A lock comes in today, and we know that we close 72% of those locks. We're going to book 72% of that revenue the day of lock, and it's a requirement for the actual fair accounting standards.
Would it be beneficial? Let me ask you this question: for a mortgage broker, do you believe that it correlates if a mortgage broker were to break down their business, if they're a large shop, that hey, when the locks come in, our percentages would actually correlate to the way the lenders do it? Do you think there's any correlation there?
It's always good to track the items of how it works and what comes in and what percentage you close, right? And if I'm running a broker shop, big, small, I always want to know where my effort is going into. How much effort am I putting into a loan? And if we're putting in a ton of effort and you have a loan officer that happens to close 40% of their loans, and a lot of them fall apart midway through the process, it's not like a good operational thing to have when you have people that are working on loans that aren't going to close, obviously. So you always want to track those mechanisms, and you want to track your lock and your lock pull through and your loan pull through. For lenders, from our side of the house, yeah, we're always tracking it, because there's a very odd part about pull through, and people always talk about pull through, and like you want it higher, you want it to be like as high as it can be. That's not necessarily true. You want to be efficient in how you close loans, but for the hedging and locking side of it, you don't want to be wrong. You don't want to be wrong on either side of it, because that means you're not in a position to be completely hedged. What you want to do is have a model, and you want to be near that model. You want that model to be right. And you always want to be tweaking the model to make sure that what you're booking in a percentage basis is what actually comes to fruition when the loans fund. That's what matters. So being wrong, it could be, hey, I thought you were going to close 70% of the loans. You end up closing 80% of the loans. That seems great, and I'd probably rather have that. However, on a hedging perspective, that means 10% of that total production was potentially just lying naked, no hedges.
This is there's a lot, like think about the extra steps that go into it. I want to give you a real life scenario of what I'm seeing a lot of, and believe it or not, this one actually involves AFR directly, and it's a bit of the pain of fallout is what I want to say. And then I want to ask the question, do lenders know when a broker switches? So let me give you a real life scenario. I believe that there's a lot more direct-to-consumer broker shops starting to come into the broker space. You're seeing it more and more over the last 5 or 6 years, and you're seeing it right across the board. And with these direct-to-consumer shops, it's lead flow coming in the door. So I have 2 angles on my company. One of them is direct-to-consumer. So this real example happened. It was a swing your way, just to give you a real life scenario. But compensation plans, with the lead flow we provide, we take additional margin. My LOs know about it. That's why I'm saying it here publicly. Doesn't bother me. It's something they get because it's something we're able to provide from us. So there's additional margin on there, which means we're very good with our margins. We hover right at about little under 2, I would say, average. I feel very good about where we're at from an industry standard, but we protect the way that our loan officers get paid. We're very compliant. In this situation, we had a loan that's in process. We're ready to go. All of a sudden, client comes in. They're shopping us very heavily. We weren't able to keep it with this lender and still pay the originator and keep margin the same without going nuts. In this case, AFR popped up where you guys were winning. So I made the call that said, hey, in order for you to get paid on this loan and keep margins the same, this loan has to move over to AFR. Now, in this situation, you guys are winning, but what actually happens when I make a call like that, or a loan officer makes a call? Do you guys have a red alert button on your side that says, oh no, it's transferring somewhere else? What do you guys see? And are you seeing more and more of this? And do you believe the direct to consumer heading to the broker area, you're going to actually see this increase as time goes on?
Yeah, no, actually, it's in all the accounting rules. It's totally fine to transfer all the loans to AFR. we want it all. I read that, and in my accounting book, it said everyone else, it's a problem, but for us, just transfer it to us. Don't take it away from it now. So from a lending perspective, yeah, the fallout is a big deal. Continuing to model and changing our fault, like even for us, we had a really good uptick in pull through because we were getting better business that was coming in. Like we have started to price accordingly for some of the higher loan balances and some of the good credit stuff that was coming in. So we had to actually tweak our models because we saw, if you go back and we go by program, by FICO scores, by the channel, we go by stage of the loan, and we have to track all of these things. It all combines into one gigantic kind of hedge report and one larger position that we're in terms of our hedges. But we do track that. We want to continuously update the model. But what happens when you take a loan, and it all depends on what happens in the market as well. But when you take a loan, let's just say when rates get a little bit better, a really easy example is, let's just say pricing gets 100 basis points better on a $200,000 loan. When that happens, you see say if you were charging 1 discount point, you now can do the loan with no discount point, right? Mm-hmm. On the other side, the lender that had that loan and say it was locked initially and rates have now gotten better, when that loan leaves, they lose all the revenue that they had booked for that particular loan. But not only did they lose the revenue for that particular loan, since rates got better, there is the other side of this. There is a hedge. Okay. There's a hedge on that lock that lender now has to pay because things moved 1%. So they're going to move, that hedge itself moved 1%. They're going to have to pay, in theory, the $2,000 that it moved. They have to pay that out to the broker dealers. So not only do you lose the loan and revenue, they actually had to pay because that loan got worth $2,000 more. They had to pay their hedge, and then they have no loan. So that's why lenders are like freaking out over pull through, but it's actually why they make it difficult for float downs as well, because when rates get better and people say, oh, just move the rate. Well, you can't. You have this other side of the equation, this hedge that has to get paid for. So they want you to keep the loan there. They just don't want to make it really easy, because someone who makes it really easy, and we talked about it in the last session, if they make it really easy, it sounds great, but it's priced in. You're paying for it over all your loans, because that just means they have more margin to be able to do it. If you're pricing super aggressive, it's not easy to do float downs at, just, oh, send an email, we'll float it down, no problem. When you start to see that, overall, that's not a really good business model, especially when rates start to come down significantly.
So walk us through the hedge process. If you were to break it down into layman terms, I understand, okay, you don't, the market moves, the hedge, you got to pay them back if this doesn't actually stay on the books. But can you explain in layman terms, what does that process look like for you on your side? And then just walk us through on the broker space, how it truly could impact us if we keep, honestly, if we keep screwing it up, because this is something that is on us. This is a habit, right? This is something that we have to protect the greater good. When people say why, well, the why is really simple. It protects us as mortgage brokers. That's the why. So that's something we can all rally behind. How do you explain the hedging process?
Yeah. So the hedging process itself, it sounds complex, and it's really not. All you're doing is, when you're taking in a lock, you have to consider like you're buying mortgages. So like you're long the mortgage itself, you're buying the mortgage. And then on the other side, to protect myself, since I have this buy on one side, I have to go ahead and sell to make sure that there's a give and take in the hedge. So what we utilize, and what most majority of the companies use the same instruments, we use what's called a TBA security to hedge. TBA is to be announced. It's like what you see on your screens with MBS Highway, MBS Live. It's what you see in there. So what you do is you take the note rate and the type of loan, and you look at where it would correlate directly in terms of what kind of coupon and what kind of security it would go into, and you actually sell forward that security. Now, we don't do it on the individual loan basis. So like we go in and we'll show this this graphic here. We'll go in and, like, let's just say for the day, I may have a 550 or $600 million pipeline of loans, and then I'm going to have what's correlated in 500 or 550 million in hedges on that. So you're kind of moving throughout the day in what's called the delta hedge. So what moves up or down during the day, you're taking up and down in your hedges. But in terms of like the layman's terms of how it's done, you lock a $500,000 loan, and that loan pulls through at 80%. I'm going to go ahead and sell forward 400,000 in mortgages. So that way I'm protecting on that product and rate. Now, there's a nuance to this, and this is something I wanted to mention to everybody, and how things are hedged and how it's done. Not all rates get shoved into the same coupon. We talked about this yesterday a little bit, or in our session one, which is crazy. Jonathan's nuts. He wakes up. We did a Sunday morning session for our session one. The guy's so committed to this business. So we got to do that one. But yesterday we talked about it, and here, with the type of hedge and how it moves, not every coupon moves the same. So if you're looking at a coupon stack in terms of the TBA securities and what you see on these screens for pricing, not every one of those coupons move. You may have the 6 coupon moves, 5 basis points, and the 5.5 coupon might move 25 basis points, and the 5 coupon might move 40 basis points. So you have to make sure you're correlating correctly, because the pricing is going. You see a lot of loan originators. This is more about a pricing structure discussion, but that's why you see a lot of originators go, how come rate says it's green 35 basis points and my pricing didn't get better? Well, we're tracking you're looking at a 5.5 coupon and your note rate 7.25. Those don't correlate. That's a different type of coupon. So we have to make sure that the loan goes into the right coupon, or we're hedging with the right instrument. Because if you're wrong, those differences are just considered a loss, a basis loss.
And you're making up the difference. I mean, you had
We make up the
you
difference.
literally
We've
have to
locked
pay
in.
it. Yeah,
We've
have
locked
the
in. Like,
cash.
we're guaranteeing that borrower is going to get what you locked in at that time. So you set time and money, and you've locked that in. I have to deliver that. And now on the other side, I have to make sure that my revenue is intact. So that's why we take out these hedges, and there's any movement is gambling. And we're not even allowed, like, I'm not even allowed to say I'm not going to hedge that piece to it. Like, I wouldn't have warehouse banks, and I wouldn't be able to conduct business as I do without hedging our whole entire, pipeline. If you don't hedge, you're at risk, and the moves can be significant because when things move, when you take in aggregate all of your locks and they move, it doesn't seem much on one loan. But if we move 100 basis points today, I know everybody would be cheering, right? I would be in the fetal position under my desk, because if it moves fast, that means cash has to go out. So if rates got better by 100 bips or pricing got better 100 bips today, at the size of our pipeline, we'd see $6 or $7 million go out the door in cash. Now it would come back with the loans when we go to sell it, but that's 20, 30, 45 days from now when those things are sold and settled. So that's the liquidity discussion we talked about yesterday. But any given, and now imagine 200, 300 basis points of move, and you start to understand, why when these rates get moving downward fast, it becomes a little bit of chaos for lenders, not only with volume, but with managing liquidity and managing your cash.
So let me ask you this question on the other end of it, right? If you're anticipating, you on your side are anticipating rates to go down, are you able to do something slightly differently to avoid that if you have enough in like going on in the background? How does that work?
Yeah. So you have to model, and you have to model things. And unfortunately, there's no way to like get ahead of what's happening, because when you start to make moves and changes in your hedges and your hedge in terms of percentages, like the move has already happened. It's in the past, right? Like, so you don't know until you're there. Now you could take a stance, and we have allowances of certain percentages of your pipeline you can allow to be long or short, depending on where you think the market is going. Like if we're stuck in a range, we may have a small little window of saying like, hey, we've been bouncing, like recently, we've been bouncing when we get near 4.1, 4.2, like that's the bottom end of the range. We know we shoot back up to 4.4 in the 10-year treasury. We know that's going to happen. So like, not that we know, but it's likely that this is not going to blow through that 4.2 or 4.1 resistance level that you see on the 10-year. Therefore, maybe we are 5%, expecting rates to back up a little bit here. So that we may put on extra coverage, but we don't have much to play with when it comes to this. You can use different instruments, but those instruments are just so expensive in the volatility that we live in that it doesn't make much sense, because we'd have to put that into our pricing model. So we like to use instruments that correlate to mortgages. You can use the 10-year treasury. You can use like swaptions and weird stuff that you can do to mitigate losses on a huge move. But in general, you just use these TBA securities, and what you see in your movement is what we see in our hedges.
So I know it sounds pretty straightforward here, but I think for the broker community, I just want to hit this point home even harder. If lenders get this stuff wrong consistently, or they're unable to figure this out, what does that mean on our side? Like a doomsday scenario is we don't have liquidity. We don't have the ability to fund. We don't have the ability to do all this, which is probably part of what we saw back in 08. But what does it actually mean for us if lenders don't get this right? And then would you say to brokers on our side, just being patient when we see rates spike down and drop, as opposed to just jumping and going nuts and trying to handle everything and keep the consumers dialed in? How do you go through that process with somebody explaining it?
Yeah, what we need to be is partners. And I say that, I know we talk about it a lot. It means so much. Like, yes, loans are going to move. Like, we get it. You're in business. Like, a loan is better than no loan. And we know that sometimes you're there. And what we talk about all the time is necessity versus convenience, right? Like, move. Yeah, if you have to move it, if it's a necessity to move it, you're going to have to move it and keep the deal. But is it just convenient? I got a quarter better over here, I'm going to flip it. And it's like, okay, I mean, it's up to you to run the business that way. Just know that overall that is affecting everybody. when those pull-throughs happen, and we're tracking and monitoring everybody's pull-through. We're tracking and monitoring. Now for us, we don't have, we have a lot of customers that send us a couple deals, one deal here, a couple deals here, because we're still considered a specialty lender, even though we're not. So we don't have a track record. It's hard to pull and say, hey, Joe's mortgage company's pull-through is 50%. Yeah, because they delivered one of 2 loans. So like that's not a true mark.
Yeah.
But for us, we track and we pay attention to it. And if we can be partners, a couple things. If it's going to move, first try and keep it with the lender that it's at. Yes, even if it's not at AFR, if it's somewhere else, before you send it to me, talk to that lender, talk to the AE, talk to the management, wherever it is, and say, hey, I may have to move this. I don't want to. I may have to move this. Anything you can do? Can we help? Can we do a float? I want to keep it with you. You've done some of the work already. You've invested some of the expense in the loan. What can you do? And you may be surprised what they say.
Yep.
Some have very rigid float down policies and rigid renegotiation policies. We understand, and I understand why, because you can't make it easy. However, if you can put forth the effort to find a way to stay at a lender, do it. It helps a ton. It helps the community. It helps everybody. But if it does have to go, please, from I'm wearing my capital markets vest today. Like, please just let your capital markets of that lender, or the lock desk of that lender, know that the loan is canceled and it's moving elsewhere. Don't hedge by keeping it over here and we're still working on the loan. We're spending money and putting time and resource. We see it all the time.
Yep.
It gets in. We got the clear to close. Hey, we have to cancel it. Can you move this over because we got cleared here? I moved it there because I wanted rates were a little better. And we're like, we just spent all this time, money, and effort to get it to the end. Didn't know it wasn't going to be here. It's now canceled. Or they just let the rate lock expire without saying a word either and doesn't move the next stage. We're still hedging. And if rates move and things go, we are literally flying in the wind here. And if the hedge goes against you, we could lose thousands and thousands of dollars on that loan. Like, that is not uncommon for a loan that is sitting there in lock status, inapproved. You've moved it. It's clear to close another lender, about to close. We don't know until it closes, obviously, and we are probably weeks behind in that tracking. But in general, that loan is sitting out there, and that loan is going up in value, down in value. Our hedges are moving. So if we could just let us know from our side, just let us know if that loan is no longer going to be here. It's going to show up in the numbers anyway. So just you're letting us know earlier, so that way we can prepare and get rid of our hedges.
The thing I love about that too, one, you said, even if it's with another lender, like, try to keep it there, which you don't hear people say that. But two, y'all, good news and bad news need to travel at the same speed, is something that I was taught. And even in this situation here, it also sets you up as a professional. And so when you do run into issues, even down the road, I'm telling you from firsthand experience, it's just easier to reach out, because if you're delivering bad news and delivering good news in a very professional manner, I promise you, these lenders remember. They really do. When your email crosses their desk, instead of them going, oh God, here we go again, they look at it and go, all right, this guy or gal, they've done XYZ before. Here's how they speak. Let me see what I can do. I have seen this happen firsthand over and over again. It's happened for many of my loans, whether it's AFR or somebody else. Why? Because even if it's bad news, I reply. Even if I have to get on the phones, I jump on the phones. I don't care. It doesn't freak me out. So just don't be afraid of that. And I promise you, it'll set you up to have such deeper and stronger relationships with your lenders, which is what you're looking to have. It's a relationship business. I don't see that changing anytime soon. So thank you for that breakdown. Rob, just a couple things here before we wrap up. You talked about TBA briefly. Now, if I'm somebody that's never heard of that before, I'm newer to the mortgage space, how do you simplify the TBA process?
Yeah, so it's just a market maker. So people are out there making the market for a baseline price for security, for mortgage-backed securities. You need to have somebody in there. Before the TBA market was out there, there was nothing that was tracking and trade. Like, the trades were your prices. Here you have something out there that people can trade off of. And there's not we're not delivering a lot of these. They're used mostly as hedge instruments, whether it's us or insurance companies that have exposure to real estate or to interest rates in general. So like it's a tool that a lot of people utilize. to then now granted you could take the security itself when you sell like a TBA like we've talked about and to put loans into it. No one would. You generally create a different type of security for that. But the TBA itself is just baseline setting a market. It's how you get your pricing. It's how you get we can pull in a feed and get our rate sheets done. It's how we use the instrument to hedge. It's how you get your pricing on MBS Highway and then MBS Live. So when you use those services, they're pulling in a TBA price. They're not pulling in AFR's pool that traded at JP Morgan for a $10 million Ginny pool. They're not taking that price. They're taking the price that these market makers are putting out there, and that's what they're tracking. So the TBA is just a liquidity function to create transparency around price in the mortgage space. It's good for us. It's good for brokers. It's good for originators. It's good for lenders. It creates a baseline that everybody knows that no matter what, this is kind of like the fallback price of that type of security. And we know what loans would go into that type of security, so we can then price our loans accordingly.
Thank you, Rob. I appreciate that, man. All right, Rob, we are wrapping up session 2, learning quite a bit, especially for our brokers out there. For those that aren't familiar just with the secondary markets, for those that aren't sure exactly how the mortgage world goes round and round, this is the breakdown that you should be looking for. And here's why. Number one, he started where you started at. First and foremost, let me just tell you there, he is an originator through and through and understands it like you would not believe. And I'm not talking 20, 30 years ago. I'm talking very recently. The other side of it for him as well is he's not afraid to get on the phones and have the tough conversations. That's the other piece that I believe is incredibly important when you're trying to learn something like this. So don't hesitate to reach out to him. Don't hesitate to ask him any questions. Rob, anything to fill us in on when it comes to hedges, locks, or anything of that nature before we wrap up session 2 and go into session 3?
Yeah, I think just having the open door and policy, and a lot of people utilize it, but not everyone does. But in terms of shooting me a message, if there's a question or something doesn't look right, or if you're not quite understanding, a lot of times people will be like, oh, the lender, can you believe they're doing this? Can you believe they're doing it this way? There's usually a reason behind it. You can't believe about a condition. Well, they probably had like an audit from Fannie or Freddie, and that's why they're asking for this all of a sudden. If there's they won't let me float this loan down or this lockdown without paying this huge fee. Well, they probably got beat up pretty badly last time rates moved down, and they had to put something in place to stop that action. So like it's about creating behaviors. There's about stuff. There's questions that are out there. There's usually a reason why. And I won't speak on behalf of all lenders, but I have a pretty good understanding of the reasoning people do things in the space. If there's a question, something doesn't look right, something doesn't sound right, or if you're just curious about how any of this stuff works, I get a lot of messages around this. There's a lot of confusion. There's a lot of people that think they know how something works, whether it's servicing, hedging, pricing. I hear a lot of times, people talk through these things and think something, and you're like, oh my goodness, that's not how it works at all. And I think a lot of times, especially the broker community thinks there's a lot more happening in terms of being able to make more money and profits and money in servicing, and than there actually is. What we have is what we have. There isn't much to it. Things are still pretty thin, as you see in earning reports all over the place for the publicly traded companies. But for all of us, there isn't a magical place to get an extra 200, 300, 400 basis points. So if there's questions that pop up, please don't hesitate to ask. Just shoot me a message, whether it's Facebook or whatever, or email. All my information's out. Like if I tell a lot of people, they're like, how do I get a hold of you? It's like, just find me. Like all my stuff's out. Like I get enough phone calls on my cell and weird text messages soliciting business or whatnot. So please feel free to reach out. I enjoy it. I love explaining this business. I want to try and help the community fill a huge gap that they have. And that may be for their future. Maybe somebody wants to do something a little different in the future. I love the broker community. I think it's the best place to originate a loan. But if maybe there's LOs out there or broker owners that want to get into a different part of the business, want to understand this part of the business for their future, I'm here. I'm here to help as best I can.
I love that, y'all. And, something somebody taught me many years ago, don't go into a conversation nervous to be wrong. Go into a conversation excited to learn something new. That's exactly what you will do here. And Rob, we appreciate you. This is session 2. I'm excited for session 3, and we are here to deliver you education every single step of the way. Talk to y'all soon. Take care.